Most countries do not collapse overnight. They do not fall because of a single war, a single election, or a single bad leader. They fall quietly, slowly, and almost invisibly. If you look at the ruins of past empires, you will not always find explosions or invasions. Instead, you will find balance sheets. You will find loans. You will find promises that could not be kept. Debt is not loud. Debt does not march into a capital city. Debt whispers. And by the time a nation realizes what is happening, it is already trapped. Today, we're going to break down how debt slowly weakens countries, why it feels harmless at first, and why even the most powerful nations are not immune. This is not about fear. This is about understanding the system that shapes the modern world. At its core, debt seems simple. A country spends more than it earns, so it borrows money. That money is used to build roads, fund schools, pay government workers, support industries, or respond to crises. In theory, this is not bad. In fact, responsible debt can help a country grow faster than it otherwise could. The problem begins when borrowing stops being temporary and becomes permanent. When debt turns into a habit. At first, everything looks fine. The economy grows. Jobs exist. Markets stay calm. Politicians point to development projects and rising GDP numbers. To the average citizen, nothing feels broken. But beneath the surface, something dangerous is happening. Interest is piling up. And interest does not care about intentions. Debt becomes destructive when a country reaches a point where it must borrow money just to pay back older debt. At that stage, borrowing is no longer about growth. It is about survival. This is when debt stops working for the country and starts working against it. Government budgets begin to change. More money goes toward debt payments and less toward healthcare, education, infrastructure, and public services. Taxes may rise. Social programs may shrink. Wages stagnate while living costs increase. Citizens feel pressure, but they often do not know the source. They blame politicians, they blame immigrants, they blame corporations. Rarely do they blame the debt itself. Because debt is invisible. One of the most dangerous things about national debt is that it removes freedom without removing sovereignty. A country may still have its flag, its constitution, and its elections, but its choices become limited. When lenders are involved, policy decisions change. A government with heavy debt cannot easily raise public spending during a crisis. It cannot freely cut taxes. It cannot always invest where it wants to. Every major decision is filtered through one question. How will this affect our ability to pay? Over time, debt begins to shape policy more than voters do. That is how power quietly shifts. Another key issue is confidence. Modern economies are built on trust. Trust that a government will repay what it owes. Trust that its currency will hold value. Trust that its financial system is stable. When debt grows too large, that trust weakens. Investors demand higher interest rates. Credit ratings fall. Borrowing becomes more expensive. The national currency may lose value, making imports more costly and inflation worse. This creates a feedback loop. Higher debt leads to lower confidence. Lower confidence leads to higher costs. Higher costs lead to even more debt. Breaking this cycle is extremely difficult. History shows this pattern again and again. Empires that once seemed uncheckable slowly weakened under financial pressure. Not because they lacked resources, but because their obligations outgrew their capacity. Debt does not destroy nations by force. It exhausts them. It drains flexibility. It reduces resilience. It turns future growth into present repayment. And the longer it lasts, the harder it becomes to reverse. One of the most misunderstood aspects of debt is who truly pays for it. When governments borrow heavily, the burden does not disappear. It shifts forward in time. Future generations inherit the consequences. They face higher taxes, fewer opportunities, weaker public services, and less economic mobility. They are asked to pay for decisions they never voted on. This creates social tension. Young workers feel the system is rigged. Older generations fear instability. Political polarization increases. Trust in institutions erodes. Debt is not just an economic issue, it is a social one. Some people argue that large countries can carry unlimited debt because they control their own currency. While this provides flexibility, it does not eliminate risk. Printing money to manage debt can lead to inflation. Inflation reduces purchasing power. It acts like a hidden tax on everyone, especially the middle and working classes. As prices rise faster than wages, people struggle even while employment numbers look healthy on paper. This disconnect fuels frustration. People feel poorer even when governments claim the economy is strong. That gap between official narratives and daily reality is where instability grows. Debt also changes global power dynamics. Countries with strong finances can influence others through loans, aid, and investment. Countries under heavy debt often lose bargaining power. They may accept unfavorable trade terms. They may privatize critical assets. They may alter laws to satisfy creditors. None of this looks like conquest. But influence achieved through debt can be just as powerful. It is important to understand that debt itself is not evil. The danger lies in losing control of it. Healthy economies grow faster than their debt. Unhealthy ones rely on debt to maintain the illusion of stability. The difference is subtle but critical. One creates future opportunity. The other delays consequences. And eventually, delayed consequences arrive. So why does this keep happening? Because debt offers short-term comfort. It allows governments to avoid hard choices. It postpones pain. It keeps systems running a little longer without structural reform. But systems built on delay eventually face reality. The longer the delay, the harsher the adjustment. The quiet nature of debt is what makes it so dangerous. There is no single moment when alarms go off. No clear line where everything suddenly breaks. Instead, decline happens gradually. Budgets tighten. Growth slows. Trust fades. People adapt, normalize the pressure, and move on. Until one day, they realize how much has been lost. The lesson here is not panic. The lesson is awareness. Nations that manage debt responsibly, invest productively, and remain transparent can sustain strong economies. Those that rely on borrowing to mask deeper problems eventually face consequences. Debt is a tool. But like any tool, it can build or destroy. The outcome depends on how it is used. As you look at global headlines, remember this. Economic collapse rarely starts with chaos. It starts with numbers, with spreadsheets, with promises made quietly and paid later. Debt does not announce itself as a threat. That is why it is so effective. And that is how it quietly destroys nations.